Okay, rolling? Are we ready? We're ready to roll. Hi, I'm Mr. Simons. Yeah. In this video, we're going to look at the current stance of Australian monetary policy, August 2018. This is going to date, so this is just a snapshot for August. Let's give you a bit of background of what's been happening with monetary policy. Let's look at a short history lesson of monetary policy. If you can look at here, what we've got is a graph, courtesy of Trading Economics and the RBA, about the cash rate. If we go back and have a look at it, we can see that the cash rate was up around, so if we go back and have a look at it, we can see that the cash rate peaked in sort of recent times, into the last 10 years or so, just in that period before the financial crisis. And what we can see is that when the financial crisis hit, that the RBA moved really quickly. And what we can see that after that period, so in the sort of GFC recovery, that the RBA was able to increase rates again as the economy normalised after that period of crisis. But what we need to do is focus on the period we're in more recently. That we had a response to the EU debt crisis. And then if we go in our more present tense, rates at the moment are at historic lows. And we're going to look at why that's the case. So let's have a look at what's happening in terms of monetary policy in August 2018. The cash rate is 1.5%. This is a historic low. And that in fact, that the cash rate has been on hold since August 2016. Sounds like the cash rate has stayed exactly where it is for 24 months. So why? Why is the RBA doing this? By keeping the cash rate low, and therefore interest rates low, that the RBA is attempting to stimulate the economy. If we've got low interest rates, less incentive to save, more incentive to spend and invest, so therefore that's going to stimulate economic activity. Also, if we're talking about monetary policy at the moment, something you should think about is that high inflation isn't a problem for the RBA. Instead, the concern is low inflation. So remember, target band? The RBA's target band for inflation is for inflation to average 2 to 3% over the course of the business cycle. As of June quarter 2018, annual headline inflation is 2.1%. The thing is that underlying inflation, now remember the difference between headline and underlying. Underlying inflation is only 1.9%. So underlying inflation is tracking below RBA's target band. So inflation is actually lower than where the RBA would like it to be as of August 2018. Our situation at the moment, interesting. So why is inflation so weak in the Australian economy? Well, it's a good question. Part of the reason is that wages growth in Australia is very soft. So average annual growth for something called the wage price index, that typically grows on an annual basis by 3.3%. But the thing is that annual growth in the wage price index in 2018 is just 2.1%. The wage growth is very weak, which is then feeding into weak prices. Also think about that there has been a lot of strong competition in markets such as retail and food, which has put downward pressure on prices. If you think about what happens with new entrants into a market, let's put this into a graph form. So if we get new entrants, the supply curve will shift to the right. So if we get new entrants, the supply curve will shift to the right, leaving us with greater supply and lower prices. Here's the $1 million question. I don't think anyone ever actually gets $1 million. I think it's a lie. So the idea is, what happens next with the cash rate? So the answer is that at the moment, and this statement comes from the RBA's monetary policy decision in July 2018, which was, surprisingly, to keep them on hold, the low level of interest rates is continuing to support the Australian economy. Okay, so the RBA is kind of happy with the effect that the current interest rate setting is having on the Australian economy. Further progress in reducing unemployment, and having inflation return to target. Having inflation return to target, that's all about price stability, is expected, although this progress is likely to be gradual. It's going to take a bit of time, but the RBA thinks we're in the right direction. Holding the stance of monetary policy unchanged would be consistent with sustainable growth in the economy, tick, and achieving the inflation target over time, tick. At the moment, the RBA is kind of waiting and seeing. It's pretty happy with where the interest rate setting is at the moment because it believes that inflation will reduce further. The RBA believes that unemployment will reduce further and then inflation will tick up again over time. So if you like what you saw in the video, give us a thumbs up, think about subscribing, maybe leave a comment, and we'll see you here next time.